If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall McLeod. Let's go, baby. All right, welcome back. It is great to see you again today. Thanks for coming on. And joining us today, I have a guest. His name is Jeff Chisum. We've been talking quite a bit lately with short-term rental operators. I had a number of them on. I've had realtors that specialize in that sort of product on as well. And so I thought it might be good to have a lender on. And as it happened, I was selling, or I am selling, a lake house, and the person buying it is a short-term rental operator. And so as you do, as we all do, whenever we get an offer on something, we call the loan officer and we ask, hey, are the buyers qualified? Can they actually execute? And can they close this deal? Lo and behold, that was Jeff. So I have Jeff on the phone with me and I'm talking to him about the type of loan that they're getting. I'm talking to him about short-term rentals in general and come to find out that he's like the go-to guy for short-term rental financing across the country. So naturally I was like, man, we got to talk. I got to have this conversation with you, so that other people can understand what you're working on and what you offer, so that we all get better and understand the types of finance product for short-term rentals. And so that's what spawned today's conversation. Jeff's a wealth of knowledge. He is actually originating for a bank called North Point. He has a website that's in the show notes, so you can go to his. It's directly branded with him so that you can tell him about the property that you're looking for. So this is key for you if you're looking to go and buy short-term rentals and add them to your portfolio. Fantastic. If you are working with clients who are looking to go buy short-term rentals, it's a great reference to have somebody like Jeff in your pocket so that you can send them and tell them about loan products. It's great for you to educate yourself always on the types of loan products that are out there so that you can then educate your clients, right? And so for so many reasons, that's why we're bringing Jeff on. Love to chat with him. He kind of goes through how he got started in real estate just briefly. We talk about the different types of products that he has. It's not a sales pitch. It's just informational reasons. If you get something out of it, obviously go and visit his site and check out some of the things that he's offering. He's also got a podcast and all those things. So for us, if you're getting something out of the show, I always ask, go on, rate and review, leave a comment, something that helps us with the reach, helps us get guests just like Jeff onto the show, and helps us grow. So without further ado, let's bring Jeff on. Let's have the conversation. Let's go. We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. All right, Jeff, it's awesome to have you on the show today. I am excited to talk short-term rentals, short-term loans with you, and dip into your expertise in the field. So thanks for coming on.
Yeah, it's good to be here. Thanks for having me, Randall.
Perfect. All right. So I want to jump in straight away. We were talking just a minute ago offline about the different types of products that you have and the different types of loans that you can do. So for all of us who are looking to buy short-term rental, buy a second home, that sort of thing, I want you to dive in and kind of tell us the 10% down loan first. Let's cover that and just kind of discuss what that is, and then how it can benefit any of us going out and looking to buy a home like that.
Yeah, no, I appreciate the opportunity. So 100% of my business is helping clients with the financing to buy vacation homes and destination areas that they plan on renting out on a short-term basis. So 90% of those clients are using the 10% down second home occupancy loan, which, for most originators, historically, they've gone through Fannie and Freddie for that product. The beginning of last year, Fannie and Freddie decided they wanted to pump the brakes on how many of those people were utilizing that loan. So, what do? Either jack up rates or you jack the fees up. They did both. For a lot of originators, that loan was no longer a viable option. So, it'd be very common to talk to a client that talked to their guy, their loan officer that they've used in the past, and to have them tell them that, we just can't do that loan. They would even say it doesn't exist. And really the bottom line is, you can't charge whatever you want to originate a loan. There's limitations. So with those higher rates and those additional fees, originators weren't even being able to pass a fees test. So they couldn't lock the deal. So in November of last year, North Point Bank is who I originate for, went out and established a relationship with the Federal Home Loan Bank, which is a whole lot less known entity compared to Fannie and Freddie, but federally backed. So in order to do business with the Federal Home Loan Bank, you have to be a FDIC insured bank. And then to participate in this program, you have to be willing to leverage some of the bank's assets basically to be able to participate in it. So what did it get us? It got us the 10% down second home occupancy loan that does not have these additional loan level pricing adjusters like Fannie and Freddie implemented. So, for one thing, we can lock the deals. The rate is lower. The fees are about 60 to 70% lower than Fannie. But it's just a lot more palatable when you're going out and you're, penciling in and you're budgeting cash that it's going to take to go out and buy one of these properties. And, that few years ago when we committed ourselves to the space was the big attraction, was the 10% down. And that was a common comment that we would get on a regular basis as well as, hey, I talked to my guy, told him I wanted to buy an investment property. And they told me, well, okay, you're going to have to put 20% down, 25% down, whatever the case may be. And what I found is their big mistake initially was telling the loan officer they wanted to buy an investment property. Now, it's an investment property. Understand, any piece of real estate that we buy is an investment property, but it's all about the usage. So with these vacation homes, the simple question from the loan officer would be, hey, I see you live in Texas. You're trying to buy this property in Florida. Is that a place you go to vacation, or you plan on staying in this property? If they would have asked that one simple question, it flips them to the lane of, well, you meet the requirements of the second home occupancy loan. You only have to put 10% down. So, that's been my big opportunity in this space, is just educating people with the correct information, because a lot of the loan officers out there didn't even have a correct understanding or had the correct policy in front of them to be able to explain the product to people. So, it used to be that it had to be a certain distance from your primary residence, that you couldn't rent it out on a short-term basis. You had to spend a certain amount of time in it. And about 3, maybe 4 years ago, actually, Fannie Mae really did away with all of those limiting factors on the product. And I don't know this for a fact, but the appearance is that they wanted to keep people out of the gray space, because they knew what they were doing with these properties. And if they were renting it out on a short-term basis, they were kind of operating in this gray area of, can I do this? Should I be doing this? Somebody told me I can't do this, but I want to do this. So, and it makes sense, right? If someone shows the ability to qualify for this 10% down second home occupancy loan on their own, without any consideration that this property is going to generate income, still be below the debt to income ratio standards, why wouldn't Fannie and Freddie be in favor of this borrower supplementing their own ability to repay the mortgage with this additional income coming in? So to me, it just made sense from a business standpoint, because Fannie and Freddie are in the business of performing loans. They just want the payment every month. So it just made sense that it was a make sense change to the policy.
Okay. And so that happened a few years ago. And then you really changed your business, it sounds like, from traditional origination into this very specific niche, which is short-term rental financing, right?
Yeah, 2020, we bought our first short-term rental. And through that, I would say 2 years before that is when I had seen an email with the change on the policy, thought it was very significant because, back then I was your typical loan officer doing, local deals for people buying primary residences. Thought that policy change was significant, stuck it in my back pocket, and ultimately in 2020 used that information for my own personal use when I used that 10% down second home occupancy to buy our first short-term rental. And then kind of how that progressed into where we are today, this being 100% of my business, is as I became a part of these different networking groups, typically on Facebook, and these different short-term rental owner communities, I found there was just tons of misinformation, and one thing led to another, and became a go-to person for the correct information. So that's where it started.
Awesome. Yeah, that's why we've got you here, so we can talk about that. Yeah.
Yeah,
Okay. So you mentioned a couple things in there. Let's go back. And so specifically on this program for the 10% down, it's the second home, vacation home is how you've described it a few times, correct? So
correct.
you can only do one, I assume, or can you have
Nope.
multiple second homes
That's a
under this?
great question.
Yeah.
Yeah, and some of the misunderstanding, I wouldn't say there's misinformation from other loan officers, but you can actually have up to 10 mortgages in your name. And there's nothing that says that all 10 of those couldn't have been originated as a 10% down second home occupancy loan.
Okay. All right. So there's 10. Do they have to be in your name, or can you put them in an LLC if you're using them
Uh,
for that purpose?
Yeah,
Rental.
another good question. So initially, the loan has to be done in your name. Title initially has to be held in your personal name, and then that was another change that Fannie and Freddie made here within the past 5 years. Is that after you meet that occupancy requirement, so with Fannie specifically, you're only committed to that occupancy requirement for 1 year.
Okay.
So after 1 year, if you wanted to transition and make it a long-term rental, or entertain some midterm rentals, absolutely no problem. And what comes with that is that you can transfer title into the name of an LLC that you're equal or majority owner in after 1 year. So that kind of leads to the next question, because I'm typically not talking to a client about doing a deal. It's usually about building a relationship because they want to build a portfolio
Yeah.
of these types of properties. Is, when does it run out? So, we look at ways or the opportunity to exhaust that 10% down second home occupancy lane. And then from there, it may be, you're switching over to the DSCR loan, which I know, we'll cover here later. That really, once you get an application in, we've got pieces of the puzzle in front of us. That's when we can say, okay, this is what the first one looks like. This is the opportunity to do another one, in a short period of time. Or the other thing that people don't understand or know is that you can use the income from that property after it's been on a tax return for a year.
Yep.
So if you're running it through Schedule E, if you're running it through an LLC, Schedule C, it has to be 2 years. But there is a point where you can use that income to, hopefully or potentially offset that mortgage debt and free up space in your debt to income ratio if on the first one you've hit that ceiling.
Got it. So you can stack them and do a 10% DSCR, maybe a 10% after 2 years, something like that. I would imagine you could kind of do that if you needed to.
Yeah, the challenging part about getting into the DSCR lane is going to be the down payment. So it's a higher requirement for that.
That's what I figured. We'll talk about that in just a sec. Okay. So you mentioned something about a fees test, and they weren't able to pass the fees test. What is the fees test?
Sure. So, they're going to tack on what's been traditional is, if you have a credit score below X amount or you're putting X amount down, they're going to build in this cost or fees into the loan that's either going to affect the interest rate or you're going to have to pay at closing.
Got it. Okay.
So
So the lenders increasing the rates to cover the risk.
yeah, Fannie and Freddie is.
Got it. Okay.
Yeah.
Okay.
They basically said last year, we think that people are stealing these properties away from people that could potentially buy them as a primary residence. So we're going to make this product a lot more challenging to access. So we slow down the rate that people are buying these properties as a second home.
Interesting policy to dictate.
Right.
Yeah.
Yes.
That's interesting.
Well, we'll leave it that.
Yeah.
Interesting. So yeah, we'll
Without
see
getting
we'll
too
see what the
political.
future holds as right as as positions change in the government, we
Yeah.
may see changes with that policy around that
Yeah.
product. Who knows?
Okay. All right. So again, we're talking you are one of the big things I always talk about is like, okay, how are we as agents able to go out? We have earned commissions. We are typically 1099 if you're with a brokerage. And so you're not showing all this income all the time. Or if you have ever invested in anything, you're writing a lot of stuff off. Even if you're not investing, you're still writing a lot of things off. So you're trying to get your income down as low so you pay as little in tax as you can. So that hinders your ability to go out and get financing on this 10% down sort of product. You alluded to it a second ago. We're talking about this DSCR loan. And so maybe you can speak to when you should be using that loan compared to the 10% down, and then talk about some of the details on the DSCR. And while you're going through that, I want to know the difference in rates between the two, but we'll touch on that.
Yeah, absolutely. So another thing a lot of people don't know when we're talking about scaling, and they don't bring it up, they just kind of assume that they know that those write-offs are going to fully affect my qualifying income. So for owners, it could be a case where they bought a property, they took accelerated depreciation, there's a big fat loss there. We can add that back into the qualifying income. So, it's a one-time event, it's not reoccurring losses, so we can add that back in. So 1099, we're usually looking at a 2-year history, and then you get to the write-offs, right? It can really affect that number in a significant way. There's two different ways. And so what I tell my clients on an application, it's not product specific. So, just because you put one thing on the application, we're not going to try to lead you in that direction because you think that's what you're going to qualify for. So we always go through a full analysis of looking at the tax returns and income documentation like I said, 90% of my clients are using that product, and they're not always W-2 employees. So it's not that there's no hope there. It just takes someone that knows what they're doing to fully qualify or fully calculate the income properly. So there may be some hope there. The other two lanes that we would look at after we've exhausted the opportunity for that 10% down lane is the DSCR loan and the bank statement loan. So the bank statement loan, we're going to look at 12 to 24-month history of bank statements, which for a self-employed person is typically going to be a whole lot stronger number than what shows up on the tax return and what's calculated on a tax return. So with that lane, we can use we still have the opportunity for 10% down. So that's a nice option. It is very labor intensive to go through that process and provide those documents.
Yeah.
So I'll have some clients that'll tell me, Jeff, I've been down the lane, I've pursued the kind of fit in the box financing. Let's skip all that. I don't want to send you a bunch of documents. Let's skip right to the DSCR lane because they have a general understanding of how that works. We're not going to use income to qualify you for the loan. The approval for the loan is based on the property's ability to show gross cash flow that would meet or exceed the principal, interest, taxes, and insurance payment. So the big difference there is that, you do have to put down 20% as an experienced investor. So that's going to be anyone that's owned a cash flow producing property for at least 12 months in the past 12 months. So you may have sold it 6 months ago. You may have sold your property 6 months ago, but it's still within that past 12 months and it was for more than 12 months. You would still qualify as that experienced investor, only have to put down 20%. Some originators can't do a DSCR loan for anyone but experienced investors. We do have an opportunity to do that deal.
All right. Why don't you tell me what the difference in, because obviously one's a fully qualified loan, one is DSCR, which is debt service coverage ratio. If you are familiar with that that term, so if you're going for, say, the 10% down, like what's a typical rate right now in this market that you're seeing compared to a DSCR loan?
Yeah, so the majority of the deals that we're locking in on that 10% down second home occupancy loan are locking in about 6.75, costing 2 points up front. And then the DSCR loan is running about 9.25, paying less than a point
Okay.
for that lock with a 3-year prepayment penalty is another important thing to know.
Any max or minimum loan amounts on either of those products?
Yeah, so the 10% down second home occupancy loan, we can go to a max purchase price of about $1,084,000. So the conforming loan limit, you're working with the conforming loan limit there. So that first lien position is the conforming loan limit is 726. So with 10% down, you can go to a max purchase price of $840,000. We can tack on a $250,000 second to piggyback on that loan. So we can go over that conforming loan limit, stay within the parameters of that conforming loan limit, qualifying, not have to go to jumbo. And then with 10% down, you can get up to $1,084,000 with the piggyback. With the DSCR loan, minimum 20% down for experienced investors, 25% down for someone who is new, who's not experienced. We can go up to a loan amount of $2 million on that.
$2 million. Okay, so I got a $2 million 9.7, 9.25. What was it? Give or take 9.5.
Nine and a quarter.
9.25. Okay,
Yep.
so I'm at 9.25, and I'm going out and buying a 2 million. So call it 20% to $2.4 million property. Is that right? Did I just do my numbers there?
I never do math in my head or in public,
Okay.
so we'll go
Let's
with
just
your
call
numbers.
it a $2 million loan, and I'm at 9%. Where are people buying properties like that, cash flowing those properties? Because the other side of it, the other question I wrote down was, can you max out your loan proceeds? But it sounded like you cannot max out your loan proceeds, just based on the DSCR, because there was something you said. So maybe I'm wrong, but I'm going to let you're the expert. Tell me, where are people buying properties that are cash flowing on,
Yeah.
2 million? And I guess the other side of that is, how are you guys calculating the gross cash flows that a property can potentially receive? Where's that number come from?
Yeah, to answer your initial question, no one is going out and buying those properties. So
Okay.
like on the 10% down second home occupancy loan, our average loan amount is $440,000.
Okay.
So people are buying right around, $500,000 properties. We do some that are more, but that's average. That's your average buyer out there. Their appetite is going to be right around $500,000. Our DSCR clients, that one's higher, but I would still say the average loan amount is about $600,000. So people are buying, $700,000-$800,000 properties typically with that DSCR loan. That's typically what we've seen. I mean, and it's all over the place. And a lot of people, cash flow is, you always want to buy a property that cash flows, but the business as a whole has dropped about 70%. So the mortgage business.
Okay.
My business has only dropped about 20% this year. And in August, we came real close to breaking my all-time record for a month. And I've been originating for 16
Russian
years.
Jeff. Yeah.
Top 1% loan originator in the United States. So definitely feel very fortunate to be in the space. But, back at the end of last year, October or so, when, all the uneasiness started in the economy started hitting the news waves. Of course, my wife catches wind of it and she's like, "Oh, what's going to happen?" I told her, I said, we will probably do better this next year than we've done most years, because the thing that I've learned about investors and wealthy people is they don't let interest rates stop them from doing what they want to do. And investors know the opportunity in this market because there's less people in the space. So, the kind of catchphrase that's been going around is date the rate, marry the house. That there will be days soon where we'll be able to catch a lower interest rate and improve our cash flow position.
Yeah. Yeah. That's, I've heard that floating around as well. It's very interesting to look at a deal, having invested quite a bit in my life, and looking at a deal and saying, I'm okay losing cash flow now because I'm going to hope that it's going to change. I still can't do that. Like, I personally just won't. Like, it has to, cash flow has to
Right.
make sense today,
Sure.
in order to do that deal. And I know I'm not everyone is like me, but that is absolutely on some of these apartments that I look at. I get things will change, it's going to be better, and you fix it up, and you're going to increase rents and do this and do that, and everything's going to just work out. I'm like, that's not reality. You got it.
Right.
So I get that, uh, but yeah, it's still just like a personal, self-preservation, I guess, is key. Like,
Well,
maintaining your
and
capital.
I will say that the majority of my clients, I call them first time, second home buyers, and they really are looking for lifestyle assets.
Yeah.
So, cash flow isn't 100% of what they're looking for, but what they do understand is they've been trying to buy one of these types of properties for a couple of years now, and they just can't get a deal. And now they're starting to see more listings. They're staying on average days on market is going up. They inquire about a property and they actually have time to analyze it and go
Yeah.
look at it. Whereas a year ago, they'd call their realtor and it was, yeah, sorry, that one's gone already.
Yeah.
So that's the big opportunities, just acquisition opportunity versus cash flow opportunity is what I've seen with my clients.
Got it. Yeah, yeah. That makes sense. So let's talk about your deals then, because I always like a good investment story. And so you started buying. You've been in real estate. Well, what's like the time frame you've been in real estate? How many years, give or take, or when did you start in real estate? Either first thing you were doing, was it originating loans, and you've been doing that ever since? What was your first
Yeah. So yeah, I became an originator in 2008.
2000? Okay, that's right. I did see that. Yeah, yeah. The
Yeah.
heyday,
So
the best time to get in, man.
yeah, I'm a survivor. So
Yeah,
yeah, it was a good lesson in what it takes to survive the business,
yeah.
because it
That's
is cyclical.
for
We've
sure.
seen these cycles, and it's nice to be able to say, yeah, the year that I got in was one of the worst.
Yeah,
So can't
that's
can't
funny.
can't any worse than that. But
No, I did loans. I was originating back in '04, '05, and then left the country, and then came back in '08 specifically to start buying and investing. So my entry into investing was the exact same time you got into to doing that. And I remember buying, first house, $10,000, and then $20,000, all these houses. And I didn't know how good I had it at the time. I just kind of happened to get in at a really good time to start buying. So knowing that you started in 2008, when did you actually go out and buy your first property for investment purposes?
yeah, so my first property we bought in 2020, and it it was one of those deals as a real estate investor, didn't know a whole lot, but I'd been around mortgages a whole lot
Yeah.
and had seen and worked with investors that were buying rental properties, long-term rental properties. And yeah, we really were just looking for a lifestyle asset that we could rent on a short-term basis and hopefully cover our cost. And it's turned into a lot more than that. Our second property we bought 6 months after we bought the first one, and we had actually toured that property at the same time when we were looking at the lake house that we ultimately bought. So, picture perfect cabin in the woods. We get out there and look at it. They didn't even have our showing on the books. They had guests in the property. It was a big
Oh,
group of golf
nice.
guys. But this property, the second one that we bought, ended up being in the middle of two fairways on a golf course in the Ozarks. It was beautiful, absolutely beautiful. But we stepped outside after we looked at it and almost got hit by a golf ball. But ultimately it was, well, this isn't the lifestyle asset we're looking for. We don't want to have to worry about stepping outside and getting hit by a golf ball, even though I love to play golf. Just wasn't the place to hang out. So, but the thing that we got to see is just a snapshot of what that property looked like operating as a short-term rental, and had been for the past 10 years. So fast forward after we bought that first property, I had some money that I had taken from previous employers, from 401ks that were sitting in there, and this had been 2 years before that. I had put it in a self-directed IRA, and it had just been, we were waiting to figure out what we wanted to do with that. So before we even bought the short-term rental, I was looking at long-term rentals. I was looking at investing in the stock market, just those different, kind of common opportunities that people look at. And the stock market, where I'm sure I know people have done really, really well. It was too complicated for me, too many unknowns, too many games being played in my mind that I didn't know who the players were. I didn't know the games. I didn't understand the games. It just felt very uncertain to me. But seeing this golf course cabin, it having a 10-year history, I like the fact that I could say, hey, there's my investment. I can touch it. It's the, cabin in the woods. If it burns down, I have an insurance policy to cover it and rebuild it. So I proposed that to my wife, and she's like, I don't know if I want to take, retirement funds and, put those and tie those up in real estate. And the next day, this was on a date night. The next day, all the Reddit and GameStop stuff happened, and it was all over social media. And I came back to my wife and I said, that's what I was talking about. I don't even understand what's going on. Things are being manipulated. I
Yeah.
never want that to be part of our money. And she said, okay, I see what you're talking about. So took half of the acquisition cost, the sales price of the cabin, from the self-directed IRA, and then used a non-recourse for the other half. And that's how we ended up buying the golf course cabin, the second one.
Oh, so you did buy the golf course place. All
Yeah,
right.
so they had taken it off the market because it was too hard for them to show, because it was booked so much.
Yeah.
They were tired, and the owner was actually a realtor as well. So they were just tired of trying to schedule these viewings at the same time that they had all these bookings. And I was like, that's exactly what I want.
Great problem
As
to
far
have.
as
Yeah.
as far as a full-time investment property, that's exactly what I want. So we ended up coming back around and buying that golf course cabin that we had viewed when we bought the lake house.
Yeah. Wow. Awesome. So, and those things, so are you using your lake house as your second home, or do you also STR, short-term rental, that thing?
Yeah, we go there when we want to, and when we're not there, then it's up on Airbnb, Verbo.
Yeah.
Yeah, so we've done really well with that property. The big joke about that initial year was June, it had 100% occupancy. July, it had 100% occupancy. August, it had 100% occupancy. But the problem with July was when you looked at the bottom line is that we stayed in the property for 14 days.
Oh, yeah.
So we kind of learned the lesson to, back off the time that we were going up there, especially during the peak season, because
Yeah.
we saw right off the bat the money that we had missed out on. So it's been performing well and it's improving.
Is-
That's the other thing that I tell people, don't expect right out of the gates that you're going to get, 70, 80, 90% occupancy. This is just like any small business that you would start, that it's going to take 2 or 3 years to ramp up and get repeat referral business, develop a system where you can follow up with past guests and develop, referral programs and things of that nature. So yeah, we love cash flow, but you've got to be realistic about it.
Yeah. So I'm curious again. So you bought in 2020, so I bet your rate was a slight smidge better than what you just told me they are today. Just a little bit.
It blows me away when I
Yeah.
catch that on the mortgage statement every once in a
Yeah.
while. Yeah.
My wife and I we talk about it and we're like, why didn't we just buy everything we get our hands on it at 2% rates, and so that's a conversation. We're kind of winding down a few of the things that we're working on. But looking back, like should have just picked everything up that we possibly could have. So yeah, good for you for doing that. Are you looking, is that hindering your ability to find your next one? Are you looking for another one?
Yeah. We truly want a portfolio of lifestyle assets. So I had a client I was talking to about a year ago, and he told me, Jeff, my strategy is really simple. It's cash flow, and I want to chase 72 degrees year round.
Yeah.
So that's our hope. When we get to retirement age, it's our biggest worry is which property can we stay in that's not going to impact cash flow. But being in Texas, where our primary residence is, where can we go to get cooler? So
Yeah. What part of
yeah,
Texas are
that
you in? I thought you were in Indiana for some reason.
no, North Texas. Yeah, so we're on the Fort Worth side of the DFW Metroplex.
Got it. Okay. All right. I'm in San Antonio. So Texas
Yeah,
boys. All right. Good to know.
you know heat.
Oh, for sure. Yeah. It abated just for a second and then it was 101 again yesterday. We were like, yeah, little
Yeah.
man's running out in soccer and just, yeah, it's something else.
Well, and yeah, our next market that we're targeting is Angel Fire, New Mexico.
Oh, yeah.
So
Yeah. It's a good area.
yeah, it's closest thing to Texas that has ski slopes
Yeah.
and much cooler weather in the summer. So
Yeah, for sure. Well, that's awesome. So before we go, I want you to maybe give us some tips. Like I said, we got a lot of real estate professionals that listen, and any advice you'd have for somebody looking to go out and buy maybe their first short-term rental?
well, first, and this is what I learned after the fact, is educate yourself. Educate yourself on what it means to be a successful owner operator, because the space has gotten more crowded over the past few years, but it's not new. So you have a lot of properties that are, ma and pa's, cabin that's been in the family for 30 years. And over the past few years, they decided to throw it up on Airbnb, Verbo. So it doesn't take a lot to make a property special, but you can also spend a lot of money on things that really don't matter, as far as amenities and the things that people expect these days. So just educating yourself before you become an owner. But there's so many great resources out there these days to educate people, not only on analyzing deals, but also, making a property great and standing out in the crowd. But what I found with, talking to hundreds and hundreds of clients is the finance piece. And of course, I'm a little partial there, but once people find out, what they qualify for and what it looks like and everything's been verified, it really puts you in that position where now you feel like you can go out there and take action once you do find that property that pencils out. So, you can talk about doing a lot of things. You can think about great ideas and how much you would love to own one of these types of properties. But, it's really lining out the things that you need to know and then putting yourself in that position where you explore the financing. So you have that confidence that when the opportunity arises, I'm ready to go because I have the right information to analyze the deal, but I've got that all important pre-approval letter ready to go.
Yeah, that makes sense. I asked you before, and I need to get this in there because this is key to some of these deals. Anytime you're analyzing them and looking at them, how are you determining the potential earnings of a property?
Yeah,
Assuming it's never been an Airbnb.
Yeah, I'm glad you brought that up. So, 10% down second home occupancy loan, it absolutely does not matter
Sure.
because we're not going to use that potential income for qualifying anyway. So it doesn't matter whatsoever. DSCR, we're going to pull credit to verify credit worthiness, verify no mortgage rates in the past 12 months. And then from there, it's your ability to put the 20 or 25% down, have 6 months in reserves, and you're pre-approved at that point. Because even if it's going to be a DSCR loan where the approval is based on cash flow, you still have to have that letter. So that's what a pre-approval for a DSCR looks like. And then from there, there's really three different sources for getting that approval to prove the ratio. One is going to be historical data from the seller. So 12 months, at least 12 months that the seller is willing and able to provide to show cash flow. But it doesn't mean that it has to have operated as a short-term rental in the past. So it could be, have no history. And in that case, when we order the appraisal, we're going to order rent comps. So as you can imagine, pick the place, 30A, the Smokies, Park City, Utah, probably not a lot of long-term rentals that they're going to be able to provide that data. So what we've seen is becoming more and more prevalent in those popular destination areas where these appraisers are getting access to short-term rental data.
Okay.
And so when they can send those comps back, we're blowing that 1-to-1 ratio out of the water. The third way, and it's on an exception basis, is we can take AirDNA data or run an AirDNA report to submit to the investor for review and approval, which the investor that we work with, they haven't waned from their appetite for these types of deals. So we have a very high success rate, especially when we show that ratio is well above that 1-to-1 ratio. So the nice thing, knowing that's a safety net, which the thing that I would say with that is you don't want to waive your contingencies. So if we have to wait for the appraisal and find out that they don't have the comps, that means we're submitting to the investor for the exception after the appraisal comes in. That could be 2 weeks, 2.5 weeks, 3 weeks down the road. You definitely want that approval contingency in place in the event that they don't approve it. So I definitely want to mention that aspect of it. But because that is a safety net, we can really establish that at the beginning. So, once we have someone pre-approved, then we invite them to send us an address, send us a property, and we can look at the viability before you even go under contract. We can tell you, hey, we ran a report, everything looks good. We can't guarantee it. Have that, approval contingency in place and have it out there. Don't shorten it to 7 days or 10 days. Keep it at the 2021 that's typical. But that's the nice thing about the DSCR is, you can have the pre-approval in place and we can really kind of pre-approve the property before you go under contract.
Yeah, got it. That makes sense. Look, we're at the top of the hour. Do you have another second for another question, or you got to jump off?
No, go ahead. Yep.
Okay. So this is something I was getting to a minute ago on the DSCR about maxing out loan proceeds. And just hearing you talk about it again, it made me think to ask it, because you're talking about the 1-to-1 ratio. So the PITI needs to be covered completely by the proceed, the gross rents. In my mind, that tells me that if the property is capable of producing, enough cash flow sufficient to cover higher loan proceeds, you are saying higher loan proceeds and potentially the purchase price, meaning I could get 100% loan to value. You're saying that's never going to happen. No matter how much money the property makes, you're always going to have to come with 25% down. Is that correct?
Correct.
Okay,
Yep.
cool. Yeah, just wanted to clarify that. So I was like, oh man, some of these things you're spitting off enough cash flow, not at 9%, I guess, but it's like,
right.
Okay. Well, hey, look, I mean, that was the last real thing that I wanted to cover. I think it's awesome what you are working on. The lifestyle assets, I love that as well. Like even before COVID hit, I was looking for lake houses and looking for properties to buy and all around lakes. And I just dove into that market head first and love the idea of owning that type of asset. And so we bought one, we subdivided, did some things. And so that's, having a mountain house, having a chasing 72-degree weather, having great golf weather. It's like, it's a great business to be in. So, that's all I got. I don't know. You sound like you were going to say something. What do you got?
No. And with all the news around short-term rentals these days, there's a lot of negativity around it, the Airbnb bust, that sort of thing. These accommodations are not going to go anywhere. There may be some challenges, but you're going to get that in any industry, any investment lane. But what I do know is families aren't going to go away. And, that's really how we got into the space, was that as a, family with 4 kids, we stopped staying in hotels. We were really solely staying in Airbnb short-term rentals. Families aren't going anywhere. There will always be the American family that wants their own kitchen, their kids under the same roof. So I think that will become more and more popular, because as I got into the space, it blew me away at the amount of people, when I said short-term rental or Airbnb, that didn't know what I was talking about. And this was 3 years ago. So it will continue to gain popularity and be the preferred means of accommodations for families. So I will stand by that statement, and we can replay this in 5 years and see if I was right.
Well, all right, we'll have you back on in 5 years. Mark it on the calendar.
Perfect.
Well, Jeff, hey man, it was good catching up. Thanks for sharing your knowledge and your expertise. I know I got a lot out of it, and I hope the listeners did as well. So catch up, take care. We'll see you guys on the next episode. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.